Earnings per share is a fundamental financial metric that shows in plain language how much of a company's profit is allocated to each share of its common stock. It is as if the company's total net profit is sliced evenly among all the ordinary shares available. In simple terms, imagine that a company's profit is a large pie, and every single share you own represents a slice of that pie. The size of your slice, which is determined by dividing the profit by the total number of shares, tells you how much profit your share has helped generate. This measurement is very useful because it makes comparing companies of different sizes easier and helps assess whether a company is growing or facing challenges. It is also worth mentioning that earnings per share is not just a static number reported on financial statements. It is a dynamic indicator used by market analysts, portfolio managers, and individual investors alike in their decision-making processes. When earnings reports are released, analysts compare the reported earnings per share with estimates to gauge whether the company has met, exceeded, or fallen short of expectations. Surprises in this measure, whether positive or negative, can cause significant reactions in the stock's price. Investors analyze these deviations to decide if the company's stock should be bought, held, or sold. As such, earnings per share serves as an essential element in both the valuation and the momentum-based aspects of trading. Its role in the market is not merely reflective, but predictive, as trends in earnings per share can spur investor enthusiasm or caution, influencing market behavior in both the short term and the long term. A further dimension to earnings per share is how trends in this measure can signal changes in a company's strategic direction or operational efficiency over a series of reporting periods. If a company is actively investing in research, development, or growth initiatives that might temporarily depress earnings, the earnings per share could fall in the near term, even though the company's strategic positioning may be improving for the long run. In such cases, an investor who is solely focused on the current earnings per share might overlook promising future prospects. This is why it is often recommended to look at earnings per share over multiple periods. A steadily rising figure over several years generally implies that the company is successfully managing its operations and capital. Conversely, a consistently falling earnings per share might raise red flags and prompt a deeper investigation into what is causing the decline. Thus, the interpretation of earnings per share always requires context and corroborative evidence from other financial measures. Watch our other videos for more on how to use earnings per share when investing.